Hi, I'm Doug Myers, President and CEO of Asbury Foundation, with the latest edition of Philanthropy Matters. Asbury Foundation is the supporting foundation for Asbury Communities, and as such, we raise funds for the benefit of the residents we serve at Asbury Methodist Village, Asbury Solomons Island, Bethany Village, Inverness Village, and Spring Hill. We always want to remind all our donors and friends that your gift benefits your community, and gifts to Asbury Foundation are tax deductible. With me today on Philanthropy Matters is Glen Todd. Glen, welcome.
Thanks, Doug. Thanks for having me back again this year to talk taxes.
Great, great. Glen, tell me a little bit about yourself and your firm.
Our firm's located here in Old Town Gaithersburg, just a few blocks from the Asbury Methodist Village campus. We've been in Gaithersburg since 1982. I have 4 CPAs in the firm, and I'm proud to say we have over 75 years worth of experience between us, and we enjoy serving Asbury community and the community at large.
And Glen, I'd like to thank you. You've been a volunteer on various boards within the Asbury family for years, and so we are grateful for you sharing your expertise and time for the benefit of the residents we serve.
It's been a bit of pleasure. It's
Sure.
been a very good pleasure.
Well, it's great to have this conversation again this year because, again, I think year-end, people start thinking, okay, what is it I have to do before December 31st? So just the first general question is, what do you advise kind of your senior clients to do with regards to tax planning as they approach year-end?
It's a little easier this year. You may recall last year, we didn't know what the tax rates were going to be until December the 17th of last year. So now we know the law that they passed at the end of last year extends all the rates and the basic tax structure through 2012.
Okay.
So at least for this short-term planning, we have a fairly stable environment. So we go to the traditional kind of tax planning that we would suggest people do. Look at their portfolios with their investors, with their advisors, and determine what they need to do for their capital gains. Do they need to match any gains and losses, that type of thing. In addition, they want to look at 2010 and 2011 kind of as a combined.
Okay.
You don't want to get into a high bracket one year and a low bracket the following year, or vice versa. You like to try to keep it as even as you can. You do this, sometimes you can accelerate income, maybe by doing some IRA planning of what you withdraw. If you've had a large drop in your deductions, you can plan to even that out some. So you ask yourself, what rate am I going to be in next year? What tax bracket am I going to be in? Am I going to have the same filing status? You know, these are some of the basic questions that you want to go through to try to smooth it out between the years.
Sure. Now, if you lock in a capital loss and to offset some of the gain, can you buy back that same asset? Like, let's say you had some stock, it declined, you lock in the loss, but is there any issue with buying it back?
Yeah, you're talking about the wash sale rules.
Right.
Okay, yes, you have a 30-day window on either side that you can't buy and sell the same stock within that 30 days and still recognize the loss.
Okay, so you got to just be careful.
You got to be careful, and that's the like kind asset.
Sure.
Right.
Are there any special tax credits or changes this year or pending for next year we need to keep an eye on?
Most of the tax credits this year were, like I said before, this fairly stable this year.
Okay.
There's not a lot of new things phasing in as far as tax credits, and particularly ones that would affect your residents. There are some tax credits for residential housing, energy credits that are still there, education credits, but there's not a lot of tax credits that will affect your residents. We want to look at long-term. You know, want to keep an eye on what's happening long term.
Okay.
But this year we're in pretty good shape.
Oh, terrific, terrific. Can you gift directly out of your IRA to a nonprofit?
Yes, that was extended in the bill last year.
Okay.
So that's a very good thing, particularly for a lot of your residents that don't itemize their deductions.
Okay.
So they can gift out of an IRA up to $100,000 directly to a charity, and they don't have to recognize that income, but they get the benefit of the of giving that money tax-free.
So does that go against their required minimum distribution?
Yes, that's the other good part.
Okay.
Is people that maybe don't need the required minimum distribution for their living expenses, this is a way they can fulfill that obligation and not have to pick up that money as taxable income in the year.
And I do know one thing to clarify for our viewers is that that has to be an outright gift to charity. It cannot be used to fund, let's say, a charitable gift annuity or charitable trust.
That's right.
So it is limited.
It's a current gift.
And it's not an additional charitable income tax deduction. Like you don't get to itemize that, but also you don't have to recognize the income. That's the benefit.
Excluding it out of income has the same effect as deducting it.
Sure.
Okay.
All right. Terrific.
You're pretty knowledgeable, Doug. Maybe you're available in the spring?
Well, you taught me a lot last year, so I'm trying to remember all these things. What are the limitations to gifting to children, grandchildren, and others?
Yeah, we have two sets of limitations. The annual limitation, which is still $13,000 to any one person in any 1 year. That's what we call below the radar. It doesn't have to be reported. Then we have lifetime giving limitations. Up until this year, that lifetime limit was $1 million. Included in last year's tax bill, they raised that to $5 million.
Okay.
So this is a significant window. We don't know how long that will stay. We know it's for 2011 and 2012. So if an individual has reached their $1 million lifetime exclusion, a lot of advisors are suggesting that they relook at their gifting and may want to do additional gifts. Or if somebody wants to transfer tax-free a substantial amount of wealth, this is a window of opportunity that they should work with their estate and tax planning to consider.
So just to follow up on that, someone who may be using this strategy as a way to reduce their taxable estate to help minimize future state taxes, because I know there's the federal estate tax exemption, but states may have a lower threshold.
Yes.
Okay.
Maryland in particular has $1 million threshold.
Okay.
So, and for Maryland, we don't have to add back those lifetime gifts to get to your taxable amount.
Okay.
So if you have an estate of $1.5 million, if you gifted $500,000, you then get below the Maryland estate tax limitations.
Okay,
so,
great. And I'm sorry, one other follow-up question.
That's good.
I know a lot of folks are very committed to education and often want to make gifts to help family get that college degree, and tuition has gone up across the country. Would that gift tax exemption or exclusion, would that apply to gifts to like a 529 plan also, if you were helping out a grandchild with a college education expense?
No, the gifting, yes, you can give to a 529 plan, and you can give up to 5 years worth. So you can give $65,000 into a 529. You mentioned about education and health care. You can also have unlimited gifts if it is paid directly to an institution. So
really?
You're not limited to the $13,000 if you paid a grandchild's college tuition and paid it directly to the institution.
So
and the same for health care.
All right.
Okay. So someone paying
like a medical bill.
Paying a medical bill.
Okay.
They can pay that directly, and it's not subject to the annual limitation.
Oh, that's great. I didn't realize that. I had a question just actually about gifting to a charity of appreciated assets. I know that they get the benefit of potentially the income tax deduction, but is there also an additional benefit related to capital gain when you make a gift?
Well, you get the deduction for the fair market value. You don't have to pay tax on the appreciation.
Okay.
So if you have an asset that is appreciated, say you paid $50 for it, its current value is $100, you contribute it, you get to deduct $100 without ever having to pay tax on that appreciation.
So as people consider their charitable giving,
absolutely,
that's something to consider.
It's a very good place to give charitable, to fund your charitable giving.
Okay. I know some of your clients have done charitable gift annuities. When does this make sense? A gift annuity provides a lifetime income to a donor based on their age, though when that donor dies, that asset comes to Asbury or another charity. But why would that make sense for someone to consider a gift like that?
That's a really nice thing that they have in the tax code, because this lets somebody make a gift during their lifetime. They get to enjoy doing their charitable giving, yet they still get an income stream from the asset. So they don't have to worry about impoverishing themselves or what if things change. They can still get that income stream, but they can see their charitable contribution working. So it's a very nice thing for someone to do that wants or needs a income stream coming back. With the current interest rates, the charitable deduction portion of that right now with the interest rates is relatively high. So it's a good time to be able to do that.
Sure. One question, that I also thought of coming into today, Glenn, is that we have a number of new residents that are either self-employed or still busy working, may have a small business. Are there any special considerations for the self-employed or small business owners that, again, they may be different than everyone else before year end?
Yeah, there's lots of things there for the person who's still self-employed or small business, particularly in trying to balance their income, because they may have higher income now, but they don't expect to be employed for the next 2 or 3 years. Maximizing what they can do in their qualified plan. A single employer or single employee plan, what we call a solo 401k, gives a lot of flexibility to defer substantial amounts of money.
So again, lots of things to consider before we get to December 31st.
And those kind of things go into their long-term plan. They know that they're at maybe a higher bracket now. They're going to be at a lower bracket. How do they smooth this out over time?
All right. And one other question that I didn't tell you in advance, but I was thinking, I read about this, and I didn't realize this was an issue. They said, be careful in kind of year-end investing if you purchase mutual funds that you buying into a tax liability as a result of a capital gains distribution. Can you talk about that a little bit?
Sure. A mutual fund is a flow-through entity. They buy and sell stocks all during the course of the year, but they have to distribute out enough capital gains or enough distribution so that it distributes out that to all the shareholders. If you're a shareholder, on the day that you get that distribution, you get taxed on it. So this time of year, between now and the end of the year, mutual funds are trying to balance out their books and seeing how much do we need to distribute out to meet our obligation. If you buy a mutual fund today and November the 15th, they give you a capital gain distribution, you instantly have tax. So you need to be careful of that, that aspect.
Well, Glenn, this has been a great discussion. If our viewers have a question or want to reach out to you and talk to you in person, how would they do that?
We're glad to talk to anybody. Sit down and talk to them for a half an hour and get to know somebody. We're locally here, as I say, in Gaithersburg. Our telephone number is 301-948-0184. And we're on the web, gtc-cpa.com.
Great.
And glad to hear from anybody.
Well, thanks a lot, Glenn. For viewers of this episode of Philanthropy Matters, if you also have a year-end tax planning question or charitable giving question, you can contact your local director of development. Also, you can go to theasburyfoundation.org for more information and contact information on the entire foundation team. Thank you very much for your continued support and your interest in the work of Asbury Foundation.